JP Morgan analyst in a research note on Monday says emerging market sovereign debt is at the mercy of the U.S. Federal Reserve's interest rate decisions as rate hikes drain capital from developing markets. JP Morgan removed Nigeria from its list of emerging market sovereign recommendations that investors should be overweighting, saying the country has not taken advantage of high oil prices, while adding Serbia and Uzbekistan in Eastern Europe. Joining me to discuss this further is Tajudeen Ibrahim, is the Director of Research and Strategy at Hill Denham Licensed Investment Banking Group here in Nigeria. Good evening. Good to see you.
Same here.
Thank you. Let's discuss. According to JP Morgan, we've seen $4 billion in net outflows since around April from emerging markets. Can we attribute this to the rate hike expectations from the Fed? Now it has happened.
Yes. I agree with you. The major driver is the rate hike in the U.S., and the rate hike is coming on the back of higher inflation. And I think it is just in line with what the U.S. Fed should do as a response to higher inflation in that environment. So we have seen a similar situation in Nigeria in the past, but in this case, we are seeing something different from a foreign portfolio inflow standpoint. But, the $4 billion outflow from emerging market is because of the higher interest rate environment in the U.S. And I think it is just in line with broad expectations.
Expectations that we're going to see similar outflows from this region, which is a frontier market?
Yes. Yes, we have been seeing, but there's a different development that we saw in the month of April. Since April of 2021, we have been seeing net outflows of foreign portfolio investment in the iron here window, based on what we are tracking as published by the FMDQ. But last month, April, we saw a surprise, which is positive, of $41 million net inflow of FPI into that segment of the FX market, which I think is partly reflective of what is happening in the equities market.
Interesting how the equities market ran. We're running about 22% on the index return on the IGX. And I say, well, congratulations to those of you who's got all your money in the market. But again, what do you make of the latest JP Morgan to take Nigeria out of this overweight basket when you're looking at when it's looking at the JP Morgan index, you're looking at the basket of government bonds globally speaking, and you look at Nigeria. Why was that decision?
I think the decision is on the back of the higher interest rate environment in the U.S. When we have higher interest rate environment in the U.S. and importantly in other key advanced economies, it is just natural for investors to look to exit emerging market and invest more in the U.S. and in other advanced economies. And the reason is that it protects them on two fronts. Number one, it protects them on the returns. So now they have higher returns in their environment. Number two, it protects them on the risk front. So they are investing at higher interest rates. They are investing at a relatively low risk. That is why you will see the flight from frontier and emerging market during periods of higher interest rate in the U.S. to advanced economies, just so that they benefit from those two key factors: higher interest rates, lower risk.
But interesting that the news report also stated that the replacement of Nigeria in that overweight category was due to what they call a fiscally cautious environment. It mentioned lack of accretion of oil proceeds into the government coffers over a couple of months by the State Oil Corporation.
Yeah, well, I think there is a lot of lessons for us to learn there. If we are compared with Serbia and Uzbekistan, and we are they are preferred compared to Nigeria. So the lesson there for us is that the government needs to take advantage of, macroeconomic indicators globally. And one key element of them is the movement we are seeing in oil prices. Oil prices have rallied significantly, in the past couple of months, currently above $100, per barrel. But because we have not put in place the right strategy and plans and also execute on those fronts to ensure that Nigeria benefits the most from that development. We are lagging on that front. By now, we should be seeing accretion to our FX reserves on the back of the higher, crude oil prices, but we are seeing our reserves being flat. So we need to really work on that, and that is the work of the government, in my view.
Yeah, that's the work of the fiscal authorities. If we take this back to Market Street and look at our own environment, the equities market is rallying strongly. Give me those sectors that you're looking at that's really outperformed for a 22%. If you exclude Zimbabwe out of the rest of Sub-Saharan Africa, Nigeria today is #1. Yeah,
it is, and I think there are 2 key or 4 factors I have seen in my mind. Number 1 is around what we are seeing in terms of low interest rate environment. If you look at Nigeria, we have short-dated instruments having lower yields. Single digits, even talking about treasury bills in this case. That kind of a development is positive for stock market. The second one is corporate earnings that have been announced. They are much stronger than last year. The third element is corporate actions. For instance, we are going to see MTN embark on its second sort of tranche of the offer for sale that it is doing in the market. The fourth element to my own mind is what we are seeing in other markets. Other markets, the stock markets over there in other frontier markets are negative. So if there's any foreign investor interest, Nigeria looks like the good destination for them to invest in terms of stock market investment.
Okay, so if you take it back to the wider market, the S&P 500 is at a 52-week low. The Pan-European 600 is at its lowest level since the 1st of March. Global stock market has generally been a little bit volatile these last few days.
Yes, volatile, and I think it is not unconnected with what we are seeing on the policy front. Let's take a look at about 7 economies that we track. We track 20 of them, but 7 of them implemented rate decisions in the month of April/May. We have Russia. Russia is an outlier. They cut interest rate by 600 basis points between April and May. We have the US. Yes. We have UK. We have Brazil. We have South Africa. And we have also, one other country, I can't remember now, but they are all raising interest rates. When you raise interest rates and your short-dated instruments on the fixed income side or on the money market side go up in terms of yields, then you'll be expecting portfolio managers to move to that portion of the market and flee away from equities. I think that, largely speaking, explains it.
That largely explains it. Is there still money here to be made? What's your advice for retail investors on the NGX? I'm sure you're going to talk about the MTN second round of offer.
Yes, let's talk about MTN, and I think one key thing
how soon is the second offer likely to happen?
I have no view yet, but I think it is still going to happen this year. But I think investors should pay attention to positive news flows in that sector.
Number one, the first quarter earnings also came in strong.
It came in strong. That's not the only thing. Yeah. We should bear in mind there are discussions around increasing tariffs. If that materializes, it is positive. They have the PSB license approval.
That's going to be positive for the telco, but the folks on the street are likely going to scratch their head whether
they will, and I agree with you. And they are crying out for a tariff increase just because of the pressure they are seeing on the cost side. When you are, exactly. So I think investors should watch out for all those things. PSB license, approval. 5G is starting in August of this year. All those are positive for MTN, and I think investors that bought the last time are smiling to the banks as we speak.
I know you did.
I did.
You did. You portfolio guys are the guys on the street. Thank you. It's good to see you for the first time again in the new year 2022. And that was Tajudeen Ibrahim from Chapel Hill.